The tech sector has run on extreme expectations that AI demand will expand without limits and that earnings will exceed even the most optimistic forecasts. Today, that narrative is facing a necessary repricing. Broadcom has guided for $16 billion in third-quarter AI chip revenue. While that is a massive increase, it fell short of some investor consensus numbers that reached as high as $17 billion. That gap was enough to trigger a 12% single-day drop in the stock, reminding us that even the hottest growth trends must eventually reckon with valuation fundamentals. Let's look at the actual numbers. Broadcom's guidance of $16 billion for third-quarter AI revenue is still an incredibly strong figure. However, the market had bid up semiconductor stocks to valuations that assumed a much larger upward revision. Although the company's full-year AI target remains unchanged at $56 billion, the guidance shortfall highlights the gap between strong business fundamentals and the extreme whisper numbers built into current stock prices. There are also structural shifts underway. Broadcom's custom silicon business is facing new long-term competition. Google, which is Broadcom's largest custom chip customer, is actively seeking to diversify its supplier base. By partnering with companies like Marvell and MediaTek, Google aims to reduce its reliance on a single provider for its TPU chips. This supplier diversification adds fundamental pressure to Broadcom's custom silicon dominance and margin outlook. Despite the volatility in semiconductor stocks, the broader S&P 500 index has remained remarkably stable. This resilience is driven by options market structure. The index is magnetically pinned near the 7,600 level by positive gamma effects. As long as this positive gamma remains concentrated, options market makers are forced to buy dips and sell rallies, acts that serve as a market shock absorber. This stabilizing effect is expected to remain active until the option expiry on June 18th. Underneath the index surface, macro liquidity continues to support asset prices. Global liquidity is currently trending higher across major regions, including the Eurozone, China, India, Canada, and Australia. At the same time, the high beta to low beta ratio has broken out above its historical 2.2 resistance level. In the past, this combination of rising global liquidity and beta breakouts has preceded vertical speculative melt-up phases, similar to the late 1990s. But while public tech sectors reprice, the private markets are revealing new details about the financial health of major private technology leaders. In its latest prospectus, SpaceX disclosed that its aggregate revenue grew approximately 33% in the fiscal year 2025. A closer look at the segments shows that the primary driver is Starlink, the connectivity business, which grew by an impressive 50%. In contrast, the company's core space launch business saw a much more modest growth rate of about 8%, confirming that SpaceX's future valuation is increasingly tied to global internet services. This growth, however, comes with rising competition and shifting cost structures for related ventures. SpaceX's affiliate, xAI, is facing intense enterprise competition, leading analysts to adjust xAI's expected long-term operating margins down from 45% to 25%. Even as xAI scales its monetization by leasing its massive Colossus compute center in Memphis to Anthropic for $1.25 billion per month, the margin compression highlights that AI infrastructure monetization is not immune to margin pressure as capacity expands. For retail income seekers, the credit squeeze makes high-yield investment traps even more dangerous. Funds investing in below-investment-grade collateralized loan obligations, or CLOs, are currently advertising distribution yields above 20%. But historical performance data shows a different reality. Over the last decade, these leveraged junk CLO funds have delivered total returns between negative 43% and negative 82%. The high payouts are funded by the steady destruction of investor capital. We are seeing a similar pattern of capital erosion in popular option strategy funds. Single stock covered call ETFs like TSLY offer yields that attract investors looking for income. Yet, because of net asset value erosion, TSLY has delivered an annual return of only 2.88% over the last 3.5 years, if distributions were not reinvested. Meanwhile, 39 out of 40 mortgage REITs have implemented dividend cuts over the last decade, proving that high yields often signal future losses. In contrast to these high-yield traps, some traditional value sectors offer defensive income structures. Dividendology notes that Comcast currently offers an 11.27% shareholder yield. This yield combines a reliable 5.27% dividend with a 6% stock buyback rate. For value investors, this disciplined capital allocation provides a sustainable income floor that does not rely on high leverage or principal erosion. These market dynamics are happening against a larger geopolitical shift. MacroVoices analysts argue that global economic policy is transitioning away from NAFTA-style globalization toward a model of economic statecraft that prioritizes national security and physical capacity. Under this new regime, governments are focused on rebuilding domestic supply chains and securing critical resources, marking a major departure from the pure financialization of the past decades. Investors can position for this domestic rebuild through targeted physical assets. The Global X U.S. Infrastructure Development ETF, ticker PAVE, offers direct exposure to the companies building U.S. factories and manufacturing capacity. This trend could accelerate if incoming Fed Chair candidate Kevin Warsh takes office, as analysts expect he would seek to align central bank monetary policy with national security and economic statecraft goals. The takeaway today is that the market's margin for error has shrunk, and selectivity is critical. High interest rates and high expectations are forcing valuation repricing across both public semiconductors and private AI infrastructure. Yet balance sheet health in private tech remains extremely strong, with SpaceX holding $25 billion in cash against $23 billion in debt, even as XAI navigates competitive margin compression. In this environment, investors must look past simple high-yield traps and focus on companies with real cash generation and clean balance sheets.